For taxpayers who itemize, this next area is usually the largest deduction on Schedule A, appearing on nearly all the Schedule A's you'll prepare. This is where taxpayers who own homes can deduct their home mortgage interest and points. Usually, the amount of interest is reported to the taxpayer on Form 1098, which comes from the mortgage company and shows the interest paid. If this was the year that your client purchased the home, it should also show the points. These points are part of the interest paid that is deducted on Schedule A. What are points? Well, when you buy a home, customarily the lender charges a fee for placing a mortgage. It's normally based on the value of the mortgage itself. It could be 1%, 2%, 3%, or any fraction or number in between. These are considered points, 1% being the most common. When you multiply the point percentage by the amount of the mortgage, it is added to the mortgage's cost and is called points, sometimes also referred to as a loan origination fee. That is a deductible item on the first mortgage for a home. If the points charged are a result of a refinance, you'll take the amount of the points and divide it by the number of years that the new mortgage is going to run in order to arrive at the deduction. Also, often when somebody buys a house or even refinances, the new mortgage company immediately sells the mortgage to someone else. So the first month's interest may be on the original 1098 form, while the remainder will be reported by another mortgage company who will also supply a 1098. I've seen as many as 5 1098 forms on one house for one client. The client refinanced, which automatically caused the creation of 2 1098 forms. But the previous mortgage owner sold the mortgage just before she refinanced, and then it was resold and then resold again. So you need to see all the 1098 forms that the taxpayer received for the year. Last year's tax return will help you determine the interest that can reasonably be expected this year. I like to look at the amount of mortgage interest deducted the prior year. If the mortgage wasn't refinanced, it's probably just a little bit less this year. For example, if the interest deduction was $10,000 last year and the client brings in a 1098 that only shows $3,000, I'm going to inquire further. Of course, it could be that the client skipped payments or paid off the mortgage, although those are less likely scenarios. What if a taxpayer went to the bank and got a home equity line of credit, also referred to as a HELOC, and used the house as collateral? Is that deductible? Sometimes, if it is used to finance substantial improvements to the house, it is still deductible. However, if it is used to purchase, say, a car, it is not. Now, I have another scenario that occurs quite often. What defines a home when considering the mortgage interest deduction? A home is defined as having sleeping, bathroom, and cooking facilities. As long as it has all three, then you can count it as a home. So if the taxpayer has a loan on a motorhome, then the interest is most likely deductible. What other interest do we have? We have investment interest and qualified mortgage insurance premiums. Investment interest is deductible to the extent of the interest and dividend income from the investments. The line qualified mortgage insurance premiums is highly specialized and will come from box 4 of the 1098 form. With the interest section complete, let's talk about gifts to charity.